March 2026 has been brutal for Singapore REIT investors. The S-REIT index just dropped 7% in a single month. That's more than triple the Straits Times Index's 2% decline. If you're holding S-REITs right now, in your brokerage, in your CPF, or through a robo-advisor, you're probably feeling the pain. So here's the big question. Is this the buying opportunity that long-term dividend investors have been waiting for? Or is this just the beginning of something worse? Stay with me for the next 10 minutes, because by the end of this video, you'll know exactly what caused this crash, which sectors you should be avoiding, which ones are still holding up, and what to actually do with your portfolio right now. Let's get into it. First, what actually happened? On the 18th of March, 2026, the U.S. Federal Reserve kept its benchmark interest rate unchanged, holding at 3.5 to 3.75%. Now that sounds neutral. Rate hold, no surprise. But the real story was in the details, specifically the Fed's updated projections. The Fed now expects PCE inflation, that's their preferred measure of inflation, to hit 2.7% in 2026. That's up from an earlier estimate of 2.4%. And critically, the majority of Fed officials now expect just one rate cut for the entire year. One rate cut. Markets immediately repriced what higher for longer really means. Singapore's 10-year government bond yield jumped 33 basis points in a single month, reaching 2.29% as of the 26th of March. That's a meaningful move. Now here's why this matters so much for REIT investors specifically. Singapore REITs are legally required to distribute at least 90% of their taxable income to unit holders. That leaves almost no retained earnings to pay down debt. Most S-REITs carry gearing ratios between 35 and 45%. That means a huge chunk of their assets are funded by borrowing. When interest rates stay elevated, three things happen simultaneously. 1. Debt refinancing costs rise. REITs with loans maturing soon have to refinance at higher rates, which directly compresses how much they can pay you in distributions. 2. Interest coverage ratios come under pressure. MAS requires REITs with gearing above 45% to maintain an ICR of at least 1.5 times. Rising borrowing costs eat into this buffer. 3. Property valuations fall. Higher capitalization rates used by valuers translate to lower asset values, which pushes gearing ratios up even without any new borrowing. Add to this the U.S. tariff environment. Washington imposed a 10% baseline tariff on Singapore exports in February 2026, with a possible rise to 15% being discussed. Singapore's GDP growth has also cooled to just 1.8% in the first quarter of 2026. That combination of rate pressure plus macro slowdown explains why S-REITs got hit harder than the broader market. So, which sectors actually took the most pain? And where are the opportunities hiding? Let me walk you through the 5 key S-REIT sectors and exactly where each one stands right now. Data center REITs are the standout bright spot. Keppel DC REIT and Digital Core REIT are benefiting from AI-driven infrastructure demand that is fundamentally insensitive to the macroeconomic slowdown. Hyperscalers like Microsoft, Google, and Amazon are committing record capital expenditure to data centers across Asia-Pacific. Singapore's supply-constrained data center market, where the government tightly controls power quota allocation, means rental growth for existing operators like Keppel DC REIT is structural, not cyclical. Long-weighted average lease expiry above 5 years gives income visibility regardless of short-term rate noise. If you want resilience in this correction, data centers are your anchor. Retail REITs are broadly neutral. Fraser's Centrepoint Trust and Lendlease REIT benefit from resilient domestic consumption. Singapore's heartland malls, anchored by necessity retail like supermarkets and food courts, are still seeing healthy footfall. Tourism spending is also holding up well. Retail REITs are not exciting, but they're not bleeding either. Industrial and logistics REITs are mixed. E-commerce demand remains structurally intact, which supports warehouses and logistics facilities. But tariff uncertainty creates hesitation around manufacturing and trade-related demand. Mapletree Logistics, Trust, and Ames APAC REIT sit in this middle ground. Solid fundamentals, but with near-term uncertainty from the trade environment. Office REITs face the toughest conditions right now. Slower GDP growth is dampening financial services and professional services hiring. That translates to softer office leasing demand and rising vacancies, particularly in the CBD. Keppel REIT and Manulife US REIT face the most headwinds. Unless you have a very long investment horizon, office REITs are not where you want to be adding exposure in this environment. Hospitality REITs are roughly neutral. Tourism remains steady, and Singapore's hotel sector is benefiting from MICE event demand and regional travel recovery. But revenue per available room growth is moderating from the elevated levels we saw in 2024 and 2025. CDL Hospitality Trusts and Far East Hospitality Trust are stable, not exciting, not alarming. Now let's talk about something that affects a huge number of Singapore investors, CPF. If you're using the CPF investment scheme, specifically your ordinary account, to invest in S-REITs or REIT ETFs, here's the current picture. Your CPF ordinary account earns a guaranteed 2.5% per annum. The Singapore 10-year government bond yield is currently 2.29%, actually below the CPF floor rate. That means your CPF is already beating government bonds on a risk-free basis. And here's the compelling part. After March's correction, the average S-REIT dividend yield has climbed above 6%. That's a yield spread of over 3.5 percentage points above your CPF OA rate. Historically, a yield spread above 3% has been associated with attractive REIT entry points for long-term investors. But, and this is important, CPF offers capital safety, while REITs carry genuine NAV risk in a rising rate environment. The yield premium is there, but so is the downside. So, what should you actually do right now? Our view is this. The March 2026 S-REIT sell-off is painful, but it's not irrational. It's the market adjusting to a higher for longer reality. For long-term dividend investors, a 7% index-level correction pushing yields above 6% is absolutely worth paying attention to. History suggests that when S-REIT yields break above 6%, patient investors who add selectively tend to be rewarded over the following 12 to 18 months. But the keyword is selective. This is not a situation where you want to buy everything that's fallen. Quality matters enormously right now. We favor REITs with gearing below 40%, the majority of debt on fixed rates rather than floating, sponsors with strong balance sheets and visible acquisition pipelines, and sector exposure to data centers or logistics, where structural demand tailwinds are working for you, not against you. We are more cautious on office and high-gearing plays where rising interest costs could force distribution cuts or, in a worst case, dilutive equity fundraises. Here are 3 concrete action steps you can take this week. First, audit your current S-REIT holdings. Check each one's gearing ratio, their weighted average cost of debt, and what percentage of their debt is on fixed rates. This information is in every REIT's quarterly or half-year financial results. It usually takes less than 5 minutes to find. Second, if you're adding positions, prioritize quality over yield. A REIT yielding 4.5% with a rock-solid balance sheet is often a better risk-adjusted choice than a 7.5% yielder with 43% gearing and short-dated floating-rate debt. Third, consider dollar-cost averaging rather than deploying a lump sum. We don't know how long the Fed keeps rates elevated. If the rate cut cycle is pushed further into 2027, S-REITs could face another leg down. Spreading your entry over 3 to 6 months reduces the timing risk significantly. We've put together a full written breakdown of this S-REIT correction, including a complete yield comparison table, sector-by-sector analysis, and specific rates we're watching. The link is in the description below. If this video helped you make sense of what's happening in the Singapore REIT market right now, please give it a like. It genuinely helps this channel reach more Singapore investors. Subscribe for daily Singapore investing content covering S-REITs, ETFs, dividend stocks, and CPF strategy. And drop a comment below. Are you buying the dip or staying on the sidelines? I'd love to hear what you're doing with your portfolio. See you in the next one.